Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Monday, March 16, 2015. Looking at a daily chart of the SPY, and today we had none other than a gap and go day. Market gapped higher in the morning and then grinded higher all day long. But some of that should be expected because it's options expiration. And we know during options expiration that the market's going to whip around quite a bit, and it's going to be up and it's going to be down. In fact, we can take this line out because this represented the head and shoulders pattern on the 60-minute chart that played out last week. So I still have, in fact, I'm going to take this out for now because we're not going to be there anytime soon. And if we start to move down, I'll put it back in, but we don't need it. So basically, the line in the sand is, there's a couple of lines in the sand. So here's where we are in terms of numbers with the market and what to expect, okay? We're probably at what I would consider the inflection point of the top side at the close today. And it was interesting because the close today really wasn't that good. The market was up higher. The SPY was up about maybe 25 or 35 cents higher than where it closed, and then it sold off after hours. And the ES contract, the S&P E-mini futures contract, this is the June contract, was up at 2072, 2073, 2071, and then as soon as the market closed and it trades for another 15 minutes, its official daily close was down several points from there, and we're trading at 2066.75, 2067. That's the line in the sand, 2067. If we begin to close hourly on the E-mini tomorrow below 2067, which coincides with about 208 roughly, give or take, on the SPY, and we begin to close underneath that hourly, and then if we close beneath that for the day tomorrow, that really signals that we're going back down to about 2030, 2029 in the S&P E-mini, which would coincide with about 35 points, $3.50, roughly, give or take, in the S&P or SPY contract or SPY ETF. So that would put us back in the 205 camp, maybe even 204.5. So those are the numbers. Now on the upside, what should happen if we had follow through on the upside? If we begin to trade above 2071 in the E-mini and about 208.50 in the SPY, up in this area where we closed today, if we begin trading up there and higher, then those lower numbers down here come off the table, and then the market could considerably go higher. And remember, we're going to make new highs this year. It's just a matter of when. It's just a matter of if we have one more pullback and then we go, or if we go from here and we grind higher. And when we grind higher, we're probably going to do so into the summer months. So there's plenty more upside. In fact, remember, we have two unresolved positions. We have an unresolved number on the downside over here. We also have had for quite a while, for actually about 4 months now, we've had an unresolved number on the upside on the E-mini at 2135. You've heard me talk about that number since last December. 2135. We will hit that number this year. We will hit that in the next few months and higher. But I just want to give you a sense of where we are today and what to expect and where that pivot point is. So that pivot point in the E-mini is about 2071, and the pivot point in the SPY is about $208.50. So above those numbers is bullish. Below those numbers, it remains somewhat suspect for this week, as we could see lower prices into the end of this week. Don't forget, we have options expiration, quadruple witching options expiration. We have a Federal Reserve meeting on Wednesday. The market will tend to get, or will get, very whippy around that time. We have a vernal equinox later in the week, and tomorrow we have St. Paddy's Day. And there's an interesting tidbit in the email that went out to members tonight about the market and St. Paddy's Day and what the market does around St. Paddy's Day. And I found that data, and I basically put it in there for you because I just thought it was an interesting factoid, if nothing else. Okay. I wanted to talk about a couple of other things. When I start to talk about the market, I look at divergences. So one divergence I saw today, in a way, was the VIX. Now, the VIX was only down 25 cents today. Now, with the S&P up 1.33% and the Dow up 1.33% and the Nasdaq up 1.2%, you would think that the VIX would have been down more, and it wasn't. So that's something that's signaling to me that even though we had a nice big update today, all that fear didn't necessarily get drained from the market. There's still fear in the market, and that's measured by the VIX. Therefore, the VIX, for all intents and purposes, was relatively flat today. So that was somewhat of a divergence. There's another slight divergence today, although the close wasn't bad, but the IWM, and I'm just going to bring up a 10-minute chart, so an intraday chart, and you can see the IWM was not strong all day. It kind of melted away for most of the day, and it really didn't show any strength while the S&P was grinding higher. So I thought that was an interesting divergence. So I'm taking note of those two things, and I'm suspect that the market's not out of the woods yet this week. I think we still satisfy the lower number, but of course we'll see how it goes one day at a time. But these are the things I'm looking at, and hopefully that's helpful to you. Let's flip over to crude oil. And crude oil was down today, and I know I've never said that before. That's a joke. Crude oil was down. Basically, what I have as a downside target, in fact, it's not really as much of a downside target. Let me get my notes here. Is 42.70. We'll call it 42.70, give or take a dime. So basically, not that that's a target, but that should provide a solid level of support. And if the market goes down tomorrow, for example, the crude oil market on the April contract, if it goes down to that number, 42.70, 42.80, 42.60, 65, in that neighborhood, and it hourly closes above that, what you can expect to see is you can expect a rally from that, probably back up into the 44.25 neighborhood pretty rapidly over the next, let's say, day. So if the market on Tuesday, the crude oil market, is down at 42.70, and we firm up around that level, you could expect higher prices up back into the 44.25 area into Wednesday. Okay, so that's a little trade that's on the books. You don't have to take the trade, just watch the trade, see if it works out. Certainly if the market doesn't get down to that level, 42.70, then the other part's not going to happen either. It's kind of an if-then statement. And sometimes my work permits me to see certain numbers. If we firm up on a downside, I can see an upside target, and vice versa. Sometimes if we go up to a certain number and we fail, I can see where that's going on the downside. And it's pretty accurate at least 80-85% of the time. So I'm giving you the benefit of what I see in the crude oil market. Let's go over to the gold market. And the gold market is interesting because it's trying to firm up, but it's not necessarily convincing yet. So here's what we have in the gold market. The line in the sand, okay, and in fact, I'm going to put the line in the sand in. Okay, the line in the sand is going to be 11.45. 11.45, okay? That's our line in the sand. Okay, if we trade below and begin hourly closes below 11.45 and certainly daily close below 11.45, there's lower prices coming. If we stay above 11.45, there's a high probability that we begin to firm up, and we'll see higher prices most likely this week. This is a critical week. It's a pivotal week, and that's a pivotal number, 11.45 in the gold market. Gold futures, this is the April contract, 11.45 is now the line in the sand until further notice. Very, very important. If we break 11.45, we immediately go down to 11.32 and test the prior low, and I don't know that that holds. So if the market breaks 11.45, be cautious, very cautious. Let's go over to the bond market now. Let's do the TLT. The bond market was up again today. The TLT was up nicely, about $1.20 today. It's up at about 128. Now remember, 124.25 was our buy area, and we're up at 128. That's almost $4. In fact, I think the market hit a high today of at least we were up about $4. Now we're probably not done yet, but we're probably close. Now here's what you have to watch out in the bond market. Around the Fed meeting, the bond market, most markets, but in particular the bond market, because of the interest rate sensitivity, is going to, here's the interest rates, is going to normally whip around during the Fed announcement. Remember here, I said if we closed below this low here at 2105, 2.105, that's the interest rate. If we closed below there, we would have more downward pressure, and that's what happened. So downside pressure in interest rates, upside momentum in the bonds continuing, although I don't know how much more there is. And if you flip back over to the TLT, the market's going to have a hard time getting through this area here at 129. So that may be an area, if you're long, to take profits at 129 on the TLT, or before the Fed announcement. If you want to be risk adverse and you don't want to be caught up in the whipsaw action around the Fed announcement, you might want to move out of that market if you're long the bond market. Okay. So let's go to the dollar. Just want to make mention of the dollar. Now, the dollar is the strong horse. We know that. Let's just flip over to a longer-term chart because you get a better picture. Here's a weekly chart. And where do these lines come from? Well, let's go to the monthly chart, and I'll show you. Okay, the monthly chart, this was the breakout. Okay, this diagonal line was the breakout. And ideally, we would have come back to test that breakout and then taken off, and that would have been a great long. We never even sniffed that breakout again. We just blew right through it. So then we had another top that I was anticipating we would stall at, and we still may because this is a monthly chart, and if we close below this line in the month of March, that will be probably a negative sign for the dollar, and we'll probably have a pullback. Now here's the interesting part. I have some indications in terms of numbers for the dollar, and I don't know how many of you trade the dollar, but it's just interesting to know nonetheless and to track it if for nothing else. So what I have is the dollar, I believe, we'll see the dollar down below 99, okay, in the next day or so. So below 99 down here by tomorrow or into Wednesday. Now, that doesn't sound like all that much, but that doesn't mean there's not more downside coming. It's just the only number I can see. Now, the low from here, from March 11th is... what's the low? 99.03. I have 98.80 as a downside target. What's this number? 99.07. No, it's still 99.80. So it's, I'm sorry. Yeah, 98.80. So it's right here. So if the dollar were to come back down this low, we may see follow through. However, I do have an indication. I do anticipate seeing the dollar at 98.80 between tomorrow and Wednesday, and that does also coincide with the Fed announcement. You can see some dollar volatility around the Fed announcement. So, I'm giving you some tickler trades. We'll watch them, see how they work out, see the value of the work, and then we'll go on from there. So we'll take it one day at a time. We're going to let the market tell us what to do. This is options expiration week. It's a time to be cautious in the market. It's not a time to be gambling. It's a time to be very, very careful and be cognizant that the big institutions will and do whip the market around during options expiration. So with that, folks, hopefully it's been helpful. I'm David Frost, mystrategicforecast.com. This was another episode of Common Sense Market Analysis. Thanks for tuning in.